I'm Ashley Osborne. I'm the CEO and co-founder of Devour Global, the digital platform that helps people make better real estate purchasing decisions. Today, I wanted to talk about the UK property market because it seems that everybody's talking about a crash in the real estate market. People are talking about prices coming off by 30%, or I saw an article the other day that talked about prices coming off by more than that. I have a really different view on what might happen in the property market over the next 12 or 18 months. I wanted to spend some time today sharing that with you. I always find that the best decisions that people make are informed decisions. There's always more than two sides to every story. We think it's worth considering what might happen and might not, and I'm going to share that with you today. I hope you enjoy it. If you like the video, please follow us. This is our first video. We're going to keep doing this and listen to what we've got to say. Thank you very much. So here we go. This is why we think that the UK property market won't crash in 2023. And I think the first part to start with is defining what a crash actually is. Because what a lot of people say is the market's going to crash, or this is going to happen, or whatever, or prices are going to collapse. But nobody actually says what they mean by a crash and also what causes it. So from our perspective, a crash is really simple. It's a decline of more than 20% in the market over a 12-month period. That's the technical definition of what a crash is. What causes crashes tends to be really high interest rates, but also things like high house prices relative to incomes, economic slowdowns or periods of recession, and cost of living pressure. The reality is we've got all of those in the UK, and it was probably interest rates that tipped the balance. They've shot up really significantly in a short period of time. But when people talk about these crashes and price corrections, I think what's really interesting to put in perspective is what they actually mean. Because people get caught up living in spreadsheets and they build these models, and the model says that something should happen because of the model says it should. But I think there needs to be a reality test. So the average house price in the UK is £296,000 as of October 2022. If house prices reduce by 10%, they go to £266,000, which is about where we were in October 21. If they reduce by 20%, £237,000, we're back to July in 2020. But if house prices fall by 30%, the average house price in the UK is going to be £207,000. That's about where the market was in March 2016. Now, that might happen, but it seems pretty crazy to me. We had a period between 2019 and 2020 where the market wasn't stalled. It just stalled at prices much higher than that. People were just sitting on their hands. And now, because of this economic pressure, people think the price is going to go even below where that point was. It seems unlikely. And I'll tell you why. Because although interest rates are high, it's very difficult to see how interest rates will get much higher. And the reason for that is simple in my mind. It's because the amount of debt in the system. So if you look at total debt, so public and private, that's the government, companies, people's car loans, all those sorts of things as a percentage of global GDP. In 1970, it was 100%. By 1999, it was 200%. But in 2020, the total debt in the global system was 330% of GDP. And in advanced economies like the UK, etc., it's about 420%, right? Now, that's kind of okay if you have low interest rates, because it means the cost of servicing your debt is relatively low. But if interest rates keep rising, it means governments, companies, people can't afford to service their debt. That creates a massive problem. And I think most central banks understand this, and they recognize they can't push the global economy into such a bad recession that there's no real way out of it for many, many years. And I think they've got this in the back of their mind. And I think in a game of chicken between central banks and inflation, I think inflation wins, right? I think that these banks will say, you know what, a bit of inflation is okay. We can live with that. And where we are with this debt trap, as an economist would say, is we've got to reduce debt. The debt has to come down. And for governments, there's only really three ways that they can reduce debt. And it's really simple. So first is they increase taxes. So you increase tax, the extra cash you have, you use to reduce debt. But the UK has got some of its highest tax rates it's ever had. And more taxes would probably mean increasing taxes for mid-income and low-income families. That's going to be pretty unpopular for any government to introduce. The other way they do it is reduce spending, right? You stop spending money on public services. The surplus that you have, you use to reduce debt. But the Conservative governments tried that once before with austerity. It wasn't particularly popular. And the cost of everything is actually going up with inflation. It seems difficult to be able to do that. And the third way that governments can do that is they just let periods of unexpected inflation carry on for a period of time. Inflation is actually a tax, but what it does is actually erodes the value of debt. So you can reduce your debt without actually doing anything and just letting inflation run for a period of time. It seems more likely to me that that's what is going to end up happening. And what that will mean is that we're in a period of stagflation. So what stagflation is essentially a situation where inflation rates are high, interest rates are high, economic growth is slow, and unemployment remains sort of steady. And what tends to happen in that sort of market is that housing markets do really well because higher mortgage rates mean that most people don't want to change. It's difficult for people to get into the housing market. Most developers don't want to build or don't build as much because construction costs are much higher. Rents go up because there's a shortage of housing. Existing debt on property reduces because it's being eroded by inflation, and residential property tends to perform relatively well. The last time that the UK had a period of stagflation, incidentally, was the 1970s, and in the UK housing market, property prices went up by 436%. So at the end of Q1 1970, you could buy the average house in the UK for about £4,000. By Q4 1980, the average price was £23,000. Now, I'm not saying that that's going to happen. All I'm saying is that there's going to be a lot of upward pressure on housing, so it's hard to see the prices might go down at the same time. And the other thing I think that doesn't get mentioned enough is we've got a very distorted housing market because the government's tried to twist and buckle to make the housing market look like what they want it to look like. So it's done things like introduce Help to Buy, where it's overstimulated parts of the market below £600,000. They've introduced stamp duty and stamp duty holidays. And again, it's stimulated parts of the market, but it's understimulated other parts. They've introduced Section 24 to make it much more difficult for landlords to offset their mortgage interest. And COVID-19 has changed the way that people use housing, but probably not forever. So people left big city centres like London to go and buy big houses in the countryside that didn't have train connections and they could sit in the dark in their living rooms and work from home. But the reality is that might not be as popular in the future because companies like our company are saying to people, we want you to work from the office. We might not want you every day of the week, but we certainly want you there more often than not. And it's going to make it very difficult for somebody that's moved 200 miles away to get into the office. So, people are what people want to do is going to change again. And I think the other things that's important to mention as well is when people talk generically about house price growth, it's not even. So not everywhere in the housing market increases by the same price. So, when you look at the sum of the English property market, it's interesting to look at, actually, London didn't grow by much between 2019 and 22, whereas places like the East Midlands and Northwest England grew massively. So 36, 33% in some of those markets, right? That's crazy, right? That is huge growth. Some of that is definitely going to get rowed back. But I think what happens in the market will depend a lot on what part of the market you're talking about. So places like the new build market is going to change. There's going to be a lot of pressure in the new build market. But there's some things that you need to bear in mind as well. So the developer model has changed. So before 2009 and the GFC, developers basically they bought land, they built buildings, they got very close to completion and they sold them. The market changed. They had to get a lot more pre-sales. So they've already built a lot of pre-sales into their supply pipelines. And also the other thing was that the type of housing that we're building has changed a lot in the UK. So there's a lot less development in London. We'll do another presentation about that shortly. And developers are building houses in fields. So especially the big house builders like Taylor Wimpey and Persimmon and Barratt, they're not building big towers in London at the moment. They're building low-rise housing in fields in the southeast and, across England and the rest of the UK. that type of housing is easy to stop. You just stop building the one you're working on, it's already sold, and you don't build any more till you sell another one. The amount of supply that comes through the system is going to reduce massively. And I think the thing is, there'll be some significant pressure on supply that hasn't been sold, and it will need to be sold, and developers will discount that for sure. But it might just look very different. In the secondary market, I think it's very different again. I think people have got to bear in mind the reality is buyers don't not want to buy, they just can't afford to buy. So the reality is either they don't have the deposit or they can't afford to service the debt at much higher levels of interest. So they're effectively priced out of the market. So what happens in the secondary market is going to depend a lot on how much pressure different parts of the market are on. So owner occupiers, yes, those that are financially distressed are going to have to sell, and there's going to be a lot of issues there. For landlords, people talk about Section 24 and the exodus of landlords and all those sorts of things. But guess what? Section 24 was introduced in 2017. Landlords have had a huge amount of time to price that in and work out what they're doing, either by rebalancing their debt or selling properties. And there are a lot of landlords that sold in 2020, 2021 at the top of the market, or 2022. So that doesn't necessarily mean that everybody's going to sort of leave the market all in one go. The other thing as well is getting away from these sort of spreadsheets and people's models. I think it's important to put in perspective the average buyer. So who is going to be distressed? Because they're the people that are going to make or break the housing market. So let's look at the average buyer. So the average buyer in the UK that is going to be under pressure is somebody who has a 2-year fixed mortgage, which comes up for renewal in the next 12 months. And there's about 300,000 or 400,000 per quarter throughout 2023. So that person bought the average house in 2 years ago when the average house price was about £250,000. Their mortgage rate is likely to go from 1.86% to 5%. What that means is if they stick with a P&I loan, their monthly payment will increase to £1,226, right? Massive. The other option, though, is if they're to sell their property and they rent for a period of time, because that's probably what they'll have to do rather than downsize, the average rent in the UK is £1,200. So are people really going to save £25 a month to be able to lose everything that they put their money into, their principal asset? I don't think so. There's this other option that nobody keeps talking about. The banks and the FCA have already said they're going to make it much easier for these people to switch to interest only for a period of time, get a mortgage holiday. They're not going to test for locking in interest rates. They're going to make it much easier for people to hold on to their homes and pay their mortgage. If you switch to 5% at an interest only rate from 1.86%, that person's going to go to a monthly payment of £950. So realistically, are they going to lose everything they own for an extra £120 a month? You got to be under a lot of pressure to do that. We think most of those people are actually going to say, I may as well stick because I've got nothing else that I can possibly do. The other thing as well, I think that's really interesting to talk about is new housing supply. It's not as much of a concern at the moment because obviously there's other things going on, but it's the thing underpinning the market. The problem with the UK is the UK's never built enough housing for what was required. So there's 2 major studies which have been done on how much housing is required in England. They're the best and most accurate studies probably. The big one is Heriot-Watt University did a study that said in order to just maintain pricing, England needs to deliver 340,000 new homes every year just to moderate pricing or keep it where it is. The government says it's about 300,000. Whichever number you take, the reality is we're nowhere near delivering anywhere near that amount of housing. And the amount of supply is actually going to go down over the next 2 or 3 years. There's going to be a lot of pressure on housing. The other thing to bear in mind is we've got a lot of immigration. I'm an immigrant, so I think they're amazing. But there were 500,000 people that moved to the UK last year. They don't all live in tents. They live in houses and they need to live somewhere. And that puts pressure on housing. I think the other thing as well that people need to bear in mind as well is there's this change that's happening in the housing market. And it's not just in the UK, it's all over. And that is the institutionalization of housing. And what has happened is that these big investment funds have started buying residential housing. They're called build-to-rent funds or multifamily housing in the US. And essentially, these big institutions are saying, we want to buy housing because we like the increases in capitals that it provides, but also the yield from the rents. And the reason for that is simple. The value of retail and commercial buildings has reduced significantly, driven by COVID, but also changes in buying habits. And it's much more difficult for those companies to make money from what they would traditionally invest in. So they're going to housing. And it's going to be much more difficult for first-time buyers to compete with build-to-rent funds. They found it difficult with buy-to-let investors. You wait till you go head-to-head with somebody with $1 billion, right? You're not going to win that, right? So a lot of that supply that we talk about, or excess supply, may well get absorbed by these big institutions that just want access to these housing markets. So that's something else that I think people need to bear in mind. So in terms of what we think might happen is 100% there's going to be correction. Pricing's going to soften. If you're in the market to sell, it's going to be a really difficult time to sell. Our advice would be don't sell. Wait if you can possibly afford. If you're in the market buying, there's probably going to be a lot of opportunity. But does that mean a crash or just a correction? I think it depends on the market. So I think some of these tier one markets, so places like London, some of the big cities, when people go back and there's more demand and pressure on housing, it's hard to see those markets coming off a lot. In places like, the market where it's gone up by 30% or more, yeah, sure, those markets might come off a lot. But is that enough to skew the average house price to make it move by 20%? We don't necessarily think so. I think the other thing is that new housing production, as that slows and gets absorbed, it's going to reduce supply. That's going to put a lot of pressure on housing. And where we think things might go is that we end up with a market that looks very different. We think we'll have an institutionalized housing market where some of these big funds have bought a lot of housing, especially traditional family housing in the UK, because that's what they're really after at the moment. And that buy-to-let investors and those sorts of guys might take up a lot of the excess new build supply. So it's hard to see that there's this sort of obvious thing that says prices might reduce by the amount of that people are actually saying. And that's just our view. We might be wrong. We're memorializing our view by recording it. But our view is that if you're in the market to buy, now's probably a good time to be thinking about what you're trying to do. Obviously, offer it a massive discount, do whatever you need to do. You might not be successful, you might be, but we don't necessarily see the huge correction that everybody's talking about. I hope you found that interesting. If you did, please follow us, and come and talk to us, DM us. We'd love to talk to you about what we're doing. Just to give you a bit of perspective about our business and what we do. I left a very large agency where I was effectively the global head of the business to set up a digital platform because I thought that first-time buyers and investors were getting screwed when they buy property. Nobody has very good information. They were paying far too much for property. So I built a property platform called Deval Global. It helps people make better investment decisions when they're buying property, and we aggregate investors together to create discounts and economies of scale. Come and visit us at www.devalglobal to find out what we do, and follow us on social media. All my social media links are on the page here. I hope you enjoyed our presentation. We'll be back with more information soon. Thank you.